Is that a miniature-sized person there? Is that now 2 miniature-sized people there? I'm gonna call the cops. Wait. If you tell me what an interest rate is, maybe I won't. Wait, how'd you just do that? Wait, what is going on here? Wait, you're coming closer. No, don't come any closer. I'll give you lower interest rates.
Daddy, what's an interest rate?
Hello everyone. Today we're diving into mortgage interest rates, a key factor in home buying that can save or cost you thousands over time. Let's start with the basics. What is an interest rate when it comes to mortgages? Simply put, it's the cost of borrowing money from a lender to buy a home. Expressed as a percentage of your loan amount, it's added to your monthly payments. For example, on a $300,000 loan at 5% interest, you pay about $15,000 interest in the first year alone, before principal of course. Over 30 years, that compounds significantly. Interest rates make up the bulk of your early payments, with more going to principal later on. Now, why do these rates go up or down? Several factors influence them. Some macroeconomic, others personal. First, the broader economy plays a big role. When inflation is high, lenders raise rates to offset that rising cost and maintain profits as well. Conversely, in a slow economy, rates drop to encourage borrowing and stimulate growth. The Federal Reserve's policies are crucial here. If the Fed hikes its benchmark rate to combat inflation, mortgage rates often follow suit. During recessions or low inflation periods, the Fed cuts rates, pulling mortgages lower. Market demand for bonds also matters, as mortgages are tied to Treasury yields. When investors flock to safe bonds, yields fall, and so do mortgage rates. And on certain times, like geopolitical tensions, rates might actually spike due to the risk. On a personal level, your credit score is huge. A high score, say 760 or above, signals low risk, so lenders offer lower rates. Poor credit, expect higher rates to cover that potential default. Loan type effects too. Fixed rate mortgages are stable, but might start higher than adjusted rates, which can fluctuate with the market, of course. A down payment size can also impact it. A bigger one, like 20%, reduces lender risk, often leading to lower rates. Loan terms also can affect it. Short terms, like 15 years, usually have lower rates than 30-year ones, though monthly payments are higher. And finally, location and property type. Riskier areas or non-standard homes might push rates up. So, how can you snag a lower interest rate? Well, preparation is key. Here is a step-by-step verbal guide for you to follow. Step 1, boost your credit score. Pay bills on time, reduce debt, and check your report for errors. Aim for at least a 720 to qualify for the best rates. This could take months, so start early. Step 2, shop around. Don't settle for the first lender that you run into. Compare quotes from banks, credit unions, and online lenders as well. Use tools like rate comparison sites to get multiple offers. Even a quarter point difference saves big over time. And step 3, make a large down payment. The larger down payment really makes a big impact. Saving 20% or more avoids private mortgage insurance and signals financial strength, often unlocking those lower rates. Step 4, consider buying points. You can pretty much pay upfront fees called discount points to reduce your rate. 1 point costs 1% of the loan and might lower your rate by as much as 0.25%. Crunch the numbers to see if it pays off based on how long you'll stay in the home. Step 5, lock in your rate. Once you find a good one, lock it for 30 to 60 days while closing. This protects against market rises, of course. Now, step 6, you want to opt for a shorter loan term if affordable. It comes with lower rates and less total interest, though higher monthly payments. And finally, improve your debt-to-income ratio. Pay down debts so your income covers obligations comfortably. Lenders love ratios under 36%. Remember, timing matters, so watch economic news and lock in during dips. In summary, mortgage rates are your borrowing costs shaped by the economy, policy, and your finances. To lower yours, build credit, shop smart, and minimize risk for lenders. Homeownership is exciting. With the right rate, it's even more rewarding. Thanks for tuning in. If you have any questions, please place them in the comments below, and we'll look into them. Also, if you're looking for any help in getting a loan, reach out to me. I'm happy to help. And lastly, if you like my content that helps you stay informed, then please take a moment to like and subscribe and share it with others. And I hope that you have a pleasant interest rate shopping experience.